Hey crypto traders! Are you tired of losing money in the market? Ever wondered how professional traders consistently make profits while you're stuck with losses? Well, you're in the right place. In today's video, we're breaking down 10 essential components of a winning trading strategy that can transform you from a losing trader to a profitable one. Whether you're trading Bitcoin, Ethereum, or altcoins, these strategies are your roadmap to success. Stick around till the end, take notes, and let's level up your crypto trading game in 2025. What is a trading strategy? In simple terms, a trading strategy is your game plan for the crypto market. It tells you when to buy a coin, when to sell, and how much risk to take. Pro traders never trade without a strategy. It's like navigating a new city without a map. A solid strategy has 3 core pillars: entry point, when to enter a trade; exit point, when to cash out; risk management, how much you're willing to lose. Today, we're diving into 10 key components: trading plan, entry and exit, support and resistance, stop loss and target, risk management, time frame, technical analysis, emotion control, price action, and pro tips that will take your trading to the next level. Let's get started. 1. Trading plan. Before you even think about placing a trade, you need a trading plan. Without one, you're just gambling, jumping into random trades and hoping for the best. A trading plan keeps you disciplined and helps you avoid losses. Here's what to include: which crypto to trade. Are you trading Bitcoin, Solana, or an altcoin like Chainlink? Choose based on market trends. When to trade. In a bullish market like Bitcoin's rally in mid-2005, look for buying opportunities. In a bearish market, be cautious or consider shorting.
How much to invest? Never risk more than 1–2% of your capital on a single trade. For example, if you have $10,000, don't put more than $200 into one trade. A trading plan is like a GPS. It keeps you on track and helps you make calculated moves for consistent profits. 2. Trade entry and exit to 30 to 4 o'clock. Timing is everything in crypto trading. Entry is when you buy a coin, and exit is when you sell. Get these wrong and you're either losing money or missing profits. Pro traders use technical analysis and discipline to nail their timing. Here's how you can do it. Entry: buy when the price hits a support level and shows bullish signals, like a strong green candle or a breakout above resistance. For example, if Ethereum is at a support of $3,500 with a bullish hammer candle, that's a good entry point. Exit: sell when the price nears a resistance level and shows signs of stalling, like a doji or bearish engulfing candle. If Ethereum hits $4,000 a resistance and starts reversing, take profits. But if it breaks $4,000 with strong volume, hold and set a new target like $4,500. Trailing stop loss: if the price keeps climbing, trail your stop loss to lock in profits. For example, if you buy Solana at $150 and it rises to $180, move your stop loss to $170 to protect your gains. Nailing your entry and exit means you're buying low, selling high, and avoiding emotional decisions. 3. Support and resistance for o'clock to 5:30. Support and resistance are the backbone of technical analysis. Support: a price level where a coin stops falling and bounces up. It's a great buying opportunity. For example, if Bitcoin keeps bouncing off $60,000 multiple times, that's a strong support. Resistance: a price level where the price struggles to break through and often reverses. For instance, if Cardano repeatedly fails to break $2.50, that's resistance, a good spot to sell. Always confirm support and resistance with multiple touches on the chart. When trading breakouts, for example, Bitcoin breaking $65,000, wait for a retest to avoid fakeouts. Use indicators like RSI or the 50-period moving average to confirm these levels. For stop loss and target: 5:30 to 7 o'clock. Every trade needs a stop loss to limit losses and a target to lock in profits. Here's how to set them. Stop loss: loss. Place it where the price is unlikely to hit unless your trade idea is wrong. For example, if you buy Binance Coin at $600 a support, set your stop loss at $580, just below the support. Avoid setting it to tight, for example, $595, as normal market swings can trigger it, or too wide, for example, $500, as a single loss could wipe out your capital. Target. Aim for a profit at least twice your risk. If you're risking $20 per coin, target $40 or more. For example, if you buy Polygon at $1.50 with a stop loss at $1.40, 10-cent risk, aim for $1.70 or higher 20-cent profit for a 1-2-2. Setting smart stop losses and targets ensures you're prepared for any outcome and protects your account. 5. Risk management 7 o'clock to 8:30. Risk management is your shield against blowing up your trading account. It's about controlling losses so you can stay in the game. Key rules: limit risk per trade. Never risk more than 1/2% of your capital. If your account is $5,000, your max loss per trade should be $50, $100 risk-reward ratio. Aim for at least 1 to 2 or 1 to 3. If you risk $100, target $200, $300 in profit. This way, even if you lose half your trades, you'll still be profitable. Use stop losses. Every trade must have a stop loss to cap losses. Without it, one bad trade can wipe you out. For example, in today's volatile crypto market, August 2025, a sudden dip in Bitcoin from $62,000 to $58,000 could crush an unprepared trader. Risk management keeps you safe and builds long-term wealth. 6. Time frame 8:30 to 9:30. Choosing the right time frame is critical, especially for intraday crypto trading. A time frame is how long each candle represents on your chart: 5 minutes, 15 minutes, or 1 hour. Each gives different signals. New traders stick to 5-minute or 15-minute charts for intraday trades. They're fast but manageable. Confirmation: use a higher time frame, like 1 hour, to confirm the trend. For example, if the 1-hour chart shows Bitcoin in an uptrend, look for entries on the 5-minute chart.
In 2025, with crypto markets moving fast, for example, altcoin pumps or Bitcoin ETF news, picking the right time frame helps you spot clear signals and avoid noise. 7. Technical analysis. Technical analysis is like reading the market's pulse. It uses past price data and charts to predict future moves. Think of it as a report card for your favorite crypto. Key tools include candlestick charts, spot patterns like bullish engulfing or doji to time entries and exits, support and resistance, identify key levels for buying or selling, trends, confirm if the market is bullish up or bearish down. Indicators, use RSI to gauge overbought or oversold levels or moving averages to track trends. Volume, high volume on breakouts confirms strength, low volume signals traps. For example, if XBRP breaks 1 point to dollar with high volume and RSI below 70, it's a strong buy signal. Technical analysis helps you trade based on data, not emotions. 8. Emotion control. Emotions are the silent killer of traders. The two biggest culprits: fear and greed. Fear: when Solana drops from $200 to $190, you panic and sell, even if it's just a pullback. Greed: when Dogecoin pumps to $0.5, you hold to long, hoping for $1, only to see it crash. To control emotions, stick to your trading plan. Use data-driven decisions, for example, indicators, patterns. Take breaks if you feel overwhelmed. Treating trading like a business, not a casino, builds confidence and keeps you in the game for the long haul. 9. Price action. Price action is the art of reading raw price movements without relying heavily on indicators. It's about understanding what the candles, support, and resistance are telling you. For example, a strong green candle at a support level, for example, avalanche at $30, signals a buy. A doji at resistance, for example, polka Polkadot at $10 warns of a potential reversal. In today's crypto market, with coins like Aptos or Arbitrum showing wild swings, price action helps you spot real opportunities and avoid fake signals. 10. Pro tips. Here are game-changing tips to elevate your trading. Practice with a demo account. Test your strategy with fake money on platforms like Binance or Bybit before risking real funds. Keep a trading journal. Log every trade entry, exit, profit, loss. Review it to spot mistakes. Avoid hype. Don't trade based on Twitter pumps or rumors. Check fundamentals, for example, Ethereum upgrades and market trends. Stay curious. Learn from YouTube, books, or courses. Even pro traders never stop learning. In 2025, with crypto markets buzzing, for example, Bitcoin hitting $65,000 or altcoins like Solana surging, these tips keep you ahead of the curve. Outro. There you have it, 10 must-know strategies to become a profitable crypto trader in 2025. Apply these, stay disciplined, and watch your trading transform. If you found this video helpful, smash that like button, subscribe to the channel, and drop a comment with your next topic request. Keep learning, keep trading, and I'll see you in the next video.